US rally rolls on, 50% tariff opens doors for India's investors, and FedEx lags. This is Vinayutam, your resident stock doctor, and welcome to a brand new episode 137 of the Stock Doctor podcast. Well, after what was a pretty bleak week for US markets, I know that I didn't cover I certainly didn't cover the Doctor's Weekly Snapshot last week, the US markets last week, but I did give you a hint. I did give you some kind of background. It was a pretty bleak week for US markets. All I'm trying to say is after a week like that, after such a negative week like that, few would have bet on such a roaring comeback. But that's exactly what transpired as Wall Street had its best week since late June. The buy on dip mentality seems to be well and truly rolling on, as any decline just keeps getting bought. All said and done, once the dust had settled, all three indices ended firmly in the green, with the Dow up 1.3%, S&P 500 up 2.4%, the tech-heavy Nasdaq jumping 3.9%. To further emphasize this bullishness, the bullishness in the market, the volatility index, the VIX index, VIX, came tumbling down to earth, declining by nearly 26%. Remember, last week it had a 36.5% jump, indicating that there was a very, very volatile week when all three indices in the red. Exact reversal 1 week later. Highest record, the record closes since late June for all three indices. And clearly that means the volatility tumbled down. There's a lot of bullishness going on. We need to find out whether it's validated or not. And we're about to do that now. So normality resumes this week. And by that, what I mean is Doctor's Weekly Snapshot is back. That's where exactly I'm going to take you straight first. So let's get to quickly welcome you to Doctor's Weekly Snapshot. There's much to cover. Now, I'm going to start off with a bit of recap, what transpired in the market and why investors got worried about 2 weeks ago. Remember, there was no segment. The segment was not there 2 weeks ago. So I'm going to give you a quick recap and then blend in what has transpired in the last week to give you a full picture. Now, I'm going to focus first on the labor market because that's where the pain most was. Long story short, US economy has shifted from months of mixed signals to clear evidence of a slowdown in growth, hiring, and consumer spending. Now, while we haven't seen inflation go crazy because of President Trump's tariffs, the labor market, which is the other agenda for the Fed is usually concerned about. Remember, the Fed has a twin agenda. The twin agenda being one is the inflation, two is labor market, the employment rate, right? So inflation, employment rate. So while one is so far so good, holding steady, and that's inflation, labor market clearly is showing signs of significant weakening. For instance, according to the July jobs data, US economy added a meager 73,000 jobs, which came in significantly below expectations and was the lowest 3-month job growth streak since 2010. Obviously, you got to exclude the pandemic because the job market just broke. Non-existent virtually. You can't really compare that with what's happening today because that's a clear outlier. But 2010 was not an outlier. It was a normal year. It was just after coming out of the financial crisis, that is. So since 2010, so 15 years ago, was the last time we saw such a low growth, such a low growth in the US labor market, 73,000. Now, to make matters worse, May and June. Now, this is something that might be mind-boggling to you, but it is mind-boggling to me. But I'd love to hear your thoughts in the comments whenever this episode gets after this episode gets published. So to make matters worse, May and June jobs report saw significant downward revisions. So essentially, they get more survey data, they recalibrate the survey, and it's either upward revision or downward revision for June and for previous months. Now, June and July was downward revision. That's not the problem. Downward revisions have happened before. What is problem? What the problem is, and I'm not joking when I say significant downward revisions. We are talking about a downward revision to the tune of 258,000 jobs. In other words, 258,000 jobs, boom. They did not. They were never existed. Remember when they say, oh, US added this many jobs, US added this many jobs in March, US added this many jobs in April. All of that. Once they do the revisions, the numbers were so different. The actual reality was so different from what they initially published, and the difference was 258,000 jobs combined for June and July. 258,000 jobs. They should never have been on that report when June and July reports were initially published. That to me is insane. I don't know what you guys think, but anything that says downward revision to the tune of 258,000, anything that says above 50,000, okay, 100,000 mad, 150,000 crazy, 200,000 ballistic, 250,000. I'm speechless. I don't have any more adjectives. I mean, I could call it insane, but clearly it's a lot more than that. So 258,000 jobs to the tune of revision for June and July downward, not upward. Upward would have been great. Downward. Yeah. And to really drive home the point, I need to really drive home the point. Sorry, my script is acting, my prompter is acting a bit weird. Yeah, and to really drive home the point, in case people, and more importantly, the ones in the Federal Reserve last week, we got the Conference Board's Employment Trends Index figure, the ETI figure, which for July came in at 107.55, marking the lowest level since October of 2024. Now, here's why the ETI is important. The ETI is important because it is designed to forecast job growth trends. When it sees unemployment, when it rises, unemployment typically increases, turning point signal likely shifts in hiring patterns, and so on and so forth. So it essentially is an indicator of how the labor market is kind of humming along or not humming along and all of that. So when even the ETI when this figure goes down, especially it's the lowest level since October last year, we have a problem. Okay, Washington, we have a problem. Federal Reserve, we have a problem. It's not particularly great. Now, the only positive takeaway I can give you, if any, was that the index has remained within a 12-month range, which means that the labor market is not completely collapsed yet. Boy, that's good news, isn't it? With 258,000 jobs downward revision, that's insane. At least there is stability, according to this trend, at least. So according to the stability, and it essentially, while there is significant weakening, it's not completely collapsed yet. And yet being the key word, because if the trend continues like this, things are not looking good, ladies and gentlemen. Now, it's not just the labor market that investors should need to worry about. Last week, we got some more bad economic data, although it was non-labor market related, but it was still bad. Now, first, we got the US services sector data, the ISM services index number, which showed that the sector only saw marginal expansion in July. The ISM services index barely was above the 50 mark, 50.1 to be exact. And remember, 50 separates growth from contraction. So 50.1 is neutral, not great. That's not great. We need to see growth. And it's what is worrying is this was a slowdown from June, because in June, this number was 50.8, significantly better, and much below expectations as well. Economists' expectations, 51.2, much better than 50.8, much better than 50.1. And it's a clear distinguish, isn't it? You clearly see a difference that it is growth. 50.1, barely 50, neither growth nor contraction. Say margin, I can't even say margin. Now, the survey data showed that persistent trade uncertainty, and the key word that's been buzzword, that's been trending everywhere, tariffs, are now significantly affecting business confidence, investment decisions, and more importantly, costs. It was not all doom and gloom, though, since business activity and new orders continued to grow modestly, indicating that demand is not completely derailed. But we're not talking about complete derailment. We want growth, right? We want growth. And when from 50.8, when the expectations are 51.2, and the actual figure goes down to 50.1, not particularly great news too. Nothing to cheer about, right? So, okay, demand stable, great, fantastic as the growth. Speaking of tariffs, let's talk about the buzzword. Can't have a segment without the buzzword. Last week was a monumental one, as reciprocal tariffs finally kicked in, bringing with them a barrage of uncertainty and chaos. Last week saw US's allies and trading partners scrambling to secure product-specific exemptions to protect key industries. And for those countries who did sign deals, plenty of them, Japan, South Korea, Pakistan, Pakistan, Indonesia, Vietnam, all of them signed some deals. These deals still lack specifics, creating ongoing negotiations and diplomatic frictions. Don't like either of those as an investor. What's complicating the scenario even further is that there is yet a clear distinction to be made between reciprocal tariffs and sectoral tariffs. Both of them overlap. So some reciprocal tariffs, there seems to be some kind of overlap. No clear distinguishment is made. Obviously, that leaves the trading partners in the dark. At the same time, exemptions are being granted, leaving allies and trading partners with more questions and answers. For instance, last week, President Trump announced 100% tariffs on all imported semiconductors. Quickly, swiftly, within a few hours later, he announced the tech companies who commit manufacturing to the United States will get full exemptions from the 100% tariffs. This followed the announcement by Apple CEO Tim Cook, who was at the White House at the time, that Apple will commit a further $100 billion to the previously announced $500 billion, 4-year US investment. Now, before you go on to say it's great news, money comes in, jobs, manufacturing, everything comes back, hunky-dory, it's all going to be good for the US economy. Think again. We don't know the full details. And many of the so-called new investment announcement simply repackage existing or planned spending. So net, not sure how much of an incremental add-on these new investments are going to be, and not much, I don't know how much of an incremental impact this would be on manufacturing, on job creation, on everything that President Trump has been, President Trump's economic agenda pins on. It also remains to be seen, this is a very crucial point I want to take. It also remains to be seen if President Trump, for some reason, is dissatisfied with the progress made by these investments. Would he remove the exemptions altogether, creating more pain to these tech companies and to the broader economy? Now, long story short, tariff picture still remains very much chaotic and confusing for investors, companies, and for the consumers. And just so you know, 6 months into the tariff game, the effects have been very mild. I mean, yes, inflation hasn't picked up, but neither has the promised reshoring, the promised paradise of US becoming, being a manufacturing powerhouse again, and nor have tariffs generated enough revenue to replace income taxes, which was actually one of the pledges of President Trump's campaign. Despite, and all of this is happening, as in all of this is happening. All of this is not happening despite seeing a significant jump in both the average effective tariff rate. It has gone from 2.3% to 18%, highest since the 1930s. And in tariff revenues have been $127 billion so far, compared to $72 billion at the same time last year. So nearly double, close to double last year. So despite this, there's no reassuring happening. There's no replacement of income tax. There's no talks of that happening. Nothing. So I've given you all the seemingly negative news, chaotic news, also gave you news that fuel uncertainty. You and I both know markets hate uncertainty. So why are they hitting records, you ask? I also asked. I also dug in. I also did the research. According to me, for all the doom and gloom, chaos and confusion, for all the negativity, companies just keep pumping out solid earnings numbers. 90% of the S&P have reported results. 81% of them have reported a positive EPS, and this percentage is above the 5-year average of 78. Revenue surprises, same thing. 81% of them have delivered a positive revenue surprise. Moreover, for the second quarter of 2025, the blended year-over-year earnings growth rate for the S&P 500 is 11.8%. If 11.8% is the actual growth rate for the quarter, once 100% of the companies have reported, it will mark the third consecutive quarter of double-digit earnings growth for the S&P index. Executives are remaining, CEOs are remaining optimistic, with an 87% decline in the mention of the word recession on earnings calls in Q2 compared to Q1. At the same time, we're also seeing a lot of companies returning the capital back to shareholders in the form of buybacks. As of now, $983.6 billion of stock has been bought back, with the figure projected to exceed $1.1 trillion by year end, which would be an all-time high in terms of stock buybacks. All this buyback is fueling the markets further, which explains why, despite the macro picture looking confusing and chaotic, markets continue to rally. Ironically, the tariff uncertainty may have created a very positive pathway for investors' wealth creation, since this uncertainty, as a result of discouraging long-term capital investments, are making buybacks a more appealing cash use option, thereby driving investor wealth. So there is a little bit of irony there. Not sure I quite like the irony. However, and this is because this may not necessarily be a good thing, as it could divert funds from factories and R&D investments. Moreover, should companies' bottom line and cash flows suffer going forward due to tariffs and whatnot, geopolitics, whatever it is, the buyback stream could dissipate faster than an F1 car, which would spell trouble for the market rally, especially since they are at the record highs. The more high you fly, more higher you go, the harder the fall. As such, I would be very, very careful, ladies and gentlemen, chasing these buyback fuel rallies. As long as earnings remain strong, expect momentum to remain strong in the markets. Momentum is well and truly back, by the way. The momentum factor is well and truly back in the US markets. But don't, I repeat, don't let the momentum take your eyes away from the underlying economic issues and uncertainties that continue to persist. On that note, we're going to head straight to India now. In our next segment, the doctor goes home, and we're going to go straight to it. Not going to mince any words. But the recent 50% tariffs imposed on India by President Trump is not good. Is not good. Make no mistake about it. It's bad. It's really bad. Question I do have, though, there is a but. There is always a but. But is it so bad that we just sell everything and go find peace in the mountains? Absolutely not, in my opinion, and I'll tell you why. I'm going to give you my rationale. Let's get into specifics first. I'm going to get into specifics first, talk to you about what's just going on, what just transpired, and then give you my take on this. Now, so essentially, as things stand, US has imposed an additional 25% tariff on India over its oil, because of its oil purchases from Russia, adding to an earlier 25%. So the total tariff, 50%. Not great at all. And these 50% tariffs will be effective from August 27th. Okay, August 27th. Keep this date in mind. I would really want you to keep this date in mind because I'll tell you why. So 50% tariffs have been imposed. Excuse me. 50% tariffs has been imposed on 50% tariffs were imposed on August 7th. I'm just going to pause. So 50% tariffs were imposed on August 7th. Not an exact birthday gift for me from President Trump. Thank you, President Trump, for that. Not appreciated at all. But jokes aside, these 50% would go into effect on August 27th. Keep that in mind, August 27th. Keep that in mind, I'll get back to it later. The sectors most affected would be labor-intensive ones, like gems and jewelry, textiles, leather, and footwear, with declining hiring intentions already seen in early FY25. First of all, 50% tariff, while steep, shouldn't come as a surprise. Okay, the 50% rate is definitely surprising, but the fact that any tariff was in excess of 25% shouldn't come as a surprise to Indian investors. Very simple reason. President Trump had clearly advertised multiple times that India would face an additional penalty in excess of the initially announced 25% tariff for buying oil from Russia. It's never going to be 25% to begin with. Let that sink in. 50% is horrible, yes, but it was never going to be 25. If you made your base case 25, never happening. Okay, the base case would have been excess of 25. 50 is the bear case. It's a worst case, but it was never going to be 25. The neutral case, base case, never going to be. Okay, this is very bad news. Certainly an exogenous shock to the Indian markets. For instance, there could be macroeconomic implications from higher oil import bill due to tariffs on oil from Russia. Actually, according to a latest report by SBI, India's oil import costs are likely to see an increase to the tune of anywhere between $9 and $12 billion by FY27 if they stop buying oil from Russia. Very, very steep price. From a financial market perspective, the tariffs are expected to add pressure on the Indian rupee, which is already weakened in response to all of this news. There are also projections that mention that the tariffs could be a drag on India's GDP growth in FY26, and it could chop off about 0.4 percentage points of India's GDP, FY26 GDP, potentially lowering forecasts below 6%. Long story short, should the tariffs persist, it risks slowing domestic manufacturing, dampening private capital investment, harming labor costs, and dragging down economic growth and currency stability for India. To make matters worse, the tariffs put about 55% of India's merchandise exports to the US, which amounts to be roughly $87 billion annually, at risk. $87 billion is about 2.5% of India's GDP, and that they are at risk now. Labor-intensive sectors, like I said, such as textiles, gems, and jewelry, leather, marine products, and chemicals are especially vulnerable. It also doesn't help that India's competitors, Vietnam, China, Indonesia, Bangladesh, and even Pakistan, all have tariff rates lower than 50%. Just to give you context, Pakistan is 19, India 50, not particularly great. This is not a cricket match. Yeah, it's not. This is tariff rate should be lower. The lower, the better. In fact, yesterday, President Trump decided to extend tariff pause on China by a further 90 days. Again, not good news when you look at from an Indian investor's perspective. That's the negative news. Enough doom and gloom. Here's why I think we shouldn't panic. Firstly, I told you to remember a date earlier, August 27th, right? The day on which the tariffs are expected to go into effect. Today is August 12th. There are 15 days, ladies and gentlemen, between now and then. In those 15 days, if the recent history has taught us anything, it is that a whole lot can change when you have President Trump at the White House. Remember, China started with a 145% tariffs back in April. Country never faced the brunt of this, as negotiations swiftly led to a pause, and they've continued to lead to a pause for another 90 days now. All those competitors I talked about earlier, they managed to make swift deals, unlike China and unlike India. Here's the deal. India cannot afford to make such a swift deal like President Trump clearly wants. I mean, he's ratcheting up the pressure because he wants a swift trade deal. This is because any swift deal, in my opinion, would mean that Indian farmers and other SME industries would suffer. This is something India cannot afford if it dreams of Viksit Bharat 2047. Bharat, or the rural heartlands, as I like to call them, have a major role to play if India has to achieve its target of Viksit Bharat 2047. As such, India should guard against predatory practices by global conglomerates and seek to capture a share of India's agricultural market without investing in sustainable market infrastructure, financing agricultural value chains, or supporting welfare schemes that actually enhance farmers' well-being. This was a point further emphasized by another SBI report. I'm an investor in SBI, so clearly I read a lot of their reports, and they tend to be very good. I'm not okay. There's a bit of bias there, given my investment side, given that I'm an investor. But you should check them out for yourself. My opinion, they're very good. So 50% are not. There's no way India should rush to a trade deal just because someone decided to say, I'm the biggest bully in the playground. Absolutely not. The other point that investors shouldn't forget are two other key developments that are about to take place very soon that could turn the story on its head. Today, I speak all about the negative news. Next week, the whole story could change. That's the fact, number one, that India and US officials continue to negotiate over a trade deal. In fact, there is a US team heading to India at the end of this month for a sixth round of trade talks. Yep, sixth round. You are not going through 6 rounds of grueling negotiations because you just woke up, not have nothing better to do, and you're like, you know what, let me negotiate for the fun of it. Absolutely not. So perhaps we need to take this 50% tariffs with a pinch of salt. And then there is the blockbuster showdown between President Trump and President Vladimir Putin this Friday in Alaska. Now, while I don't expect any concrete deals there, simply because Ukraine, has clearly and rightfully, in my opinion, said that no deal can be made without their presence. I mean, they're part of the equation, guys. Again, not speaking political, just not being political, just speaking common sense. Anyway, any positive conclusions from the showdown of the two of the most powerful men on the planet could lead to a U-turn on the tariff decisions, even though a concrete deal may not materialize. Remember, China got a 90 break today, which to me does sound of what's to come. China is a big importer of Russian crude as well. Yes, India may not have the rare earth magnets blackmail card up their sleeve. There's no way China doesn't get any repercussions for importing from Russia. Bottom line, investors, in my opinion, should take this 50% tariff as it is. Bad news for sure, perhaps a short-term hit if they do get imposed, certainly not a long-term structural headwind. Remember, India and the US continue to have strategic friendly relations to this day. US continues to see India as a strategic partner and as a reliable ally to counter any Chinese aggression in the South China Sea in that particular area. As such, I don't see, or I can't predict On that note, we're going to head straight to the final segment, Dr. Dissect. Sorry, I had to cut. There's a little problem here with the Zoom just stopped. So I know what's going on. I'm hoping that it's okay because I'm recording via Zoom and for some reason it's just popped and came back. So I had to cut the camera. Hopefully this goes well. Okay. Now, welcome to Dr. Dissect segment from cybersecurity. It's a lot going on. First of all, I've got like some technical difficulties today because my laptop's microphone seems to be broken. Got to fix that. And then when I went to Zoom, suddenly it just went kaput. So I don't know how much I've got it. So welcome to Dr. Dissect segment. From cybersecurity last week, we turn our attention to logistics this week. Stock going under the microscope is FedEx Corp, ticker FDX. Now, FedEx reported its Q4 numbers towards the end of June. It was a beat on both the top and bottom line estimates. Despite a quarter where it beat analyst estimates, guidance was once again a letdown. Citing tariff-related uncertainties, the company didn't provide any outlook for FY26. However, it did provide guidance on the first quarter, which fell way short of estimates. More specifically, Q1 revenues are now expected to be in the range between 0 and 2% year over year. Adjusted EPS is now expected to come in between $3.40 and $4, with the midpoint of the guidance, $3.70, falling well short of expectations of $4.05. One of the key takeaways from FedEx's quarter milestone the management simply couldn't stop bringing up during the earnings call was that the company achieved its target of generating $2.2 billion in cost cuts in FY25. I've rarely seen a company celebrate merely meeting its target. I mean, I understand the celebration when it exceeds a target, but the bare minimum should be meeting the targets, right? Have you ever let me know in the comment section later on if you do see any company that celebrates. Oh yeah, we met the target. Let's celebrate. Thought you should exceed, then that's cause for celebration. Meeting is the bare minimum. Nonetheless, the achievement is still a positive for the company and does lend the management some credibility, not much. Furthermore, the operating margins in Q4 did see a jump compared to previous quarters, which shows that the management's cost-cutting efforts are indeed paying off. However, this is not to say that I would buy into their optimism, which is once again excessive during the earnings call, despite a lackluster performance. For instance, FedEx Express continued to see a declining growth both on a year-over-year basis, and on a sequential basis. The average daily volumes for its international division fell off a cliff as the company suffered from both the US-China trade war as well as the removal of the de minimis exemption for Chinese goods. At the same time, the international business doesn't seem to gain much traction even during the current quarter. For instance, company cut capacity on its Asia to Americas network by more than 35% in the first week of May relative to April, a period when US-China trade war was at its peak. All management mentioned during the earnings call was that they're prepared to bring capacity back should demand shift, which suggests to me that things are not looking great on the international front for the company as things stand today. Furthermore, the company's B2B business continues to remain under pressure due to the ongoing macro uncertainties. At the same time, the growth of the B2C segment is also under threat if the latest US consumer metrics are to go by. So while Q2 could see a marginal uptick in B2C segment, based on management's comments, the ongoing deterioration in consumer confidence would imply that it could very well be a one-off quarterly uptrend. Finally, the company continues to refresh its aircraft fleet as it focuses on modernizing its network. The latest quarter was no different as it booked a $21 million impairment charge due to aircraft retirement. Process is nowhere near complete, which means the company is likely to continue to face short-term headwinds as a result of this initiative. If you take all of this together, while the progress made on the drive front is certainly commendable, it is no cause for celebration, in my opinion. The issues arising from a challenging macro environment, especially for its international vertical, continue to plague the company. That's not going to end anytime soon. The cost-cutting program has certainly improved the company's margin, but growth is unlikely to return anytime soon. With that, got a notebook, got a pen, can only mean one thing, it's valuation time. So valuation time, FedEx. Right. The company's total adjusted EPS for FY25 came in at about $18.19, marginally higher than my estimate of $18, which is also the company's lower end of the FY25 guidance, by the way. Last time I talked to you about FedEx, I argued how there's a very strong likelihood of the company lowering guidance once again. Now, while the company decided not to provide any guidance for FY26, Smart choice, in my opinion, given how bad the management has been with respect to their projections. The midpoint of Q1 EPS, however, once again fell short of estimates. Now, according to Seeking Alpha, FedEx currently trades at a forward price to earnings of 12.3, trading at 11.5 last time. Still trading below its 5-year average, historical average multiple of 13.7. The company has already offered a weak EPS guidance for Q1, which in my opinion means that the company is highly likely to fall well short of its long-term average EPS growth of 11.6%. As such, I've left my forward PE estimate at 11.5. So FedEx background. Much better. There you go. FedEx forward price to earnings of 11.5. Now, the company currently trades at a forward PEG ratio of 1.1, in line with its 5-year average of 1.12, but well below the sector median of 1.81. At the ratio, so PEG ratio is 1.10. At this ratio, assuming a forward price to earnings of 11.5, FY26 EPS growth would be 10.45%, which is about the same as last time I talked to you guys. Now, I told you this growth rate is absolutely unrealistic. 10.45, absolutely not. I'm going to put a crossover there straight away. It's simply not realistic. So, according to LSCG data, the market implied EPS growth for FY26 is 3.76%. The figure was 4.02%. Decline in implied EPS growth makes sense to me, given that the company enters FY26 with a lot of uncertainties, and despite the cost cuts, macroeconomic challenges are eating into its bottom line. As such, what I've done is I've assumed this figure, the 3.76 growth figure for my calculations. So forget 10.45, it's 3.76. And that can only mean that projected FY26 EPS comes in at 1887, slightly higher than my previous multiple of 1872. So you take 11.5, multiply that by 1887, and you get a price target of about 202, which implies a further downside of about 9% from current levels. Stock also has a very poor momentum grade. Seeking Alpha's momentum scale, short-term momentum grade is C-. That's bad. Taking all of this together, ladies and gentlemen, I am maintaining my sell rating on the stock. FedEx has always been, I don't think I've ever updated FedEx, maybe once, but it continues to remain, but it's sell to hold and then hold back to sell. I'm maintaining my sell rating. It's simply not a stock I would touch. And just to let you know, though, I am maintaining my sell rating on the stock with the same caveat as the last time I told you guys. My call is not to short the name. There's barely any returns there after accounting for fees, transactions, leverage, all of that. But a recommendation for existing investors to probably sell their position. That's what I mean by sell. I'm not selling you to actively short. 9% is not enough. I don't think it's enough to after accounting for all the other transaction costs, all the other hoopla. So all I'm telling you is it comes with the same caveat. This is not to short, but if you're an existing investor, probably time to get out. Just like when I issue a buy rating on and mention the risk factors, I have to do the same for a sell rating. One of my risk factors that I mentioned last time was that the management could exceed the targets set out under the Drive initiative. While this didn't materialize, the company matched its target of achieving 2.2 billion in cost cuts. Should the industrial economy improve in the US, however, company could see an uptick in the B2B vertical, which could further result in improved revenues and earnings. The other risk factor is the company's healthcare vertical is significantly improving. Now that the company has achieved the CEIV certification, significant achievement, the company's healthcare vertical could show continued growth, which would subsequently result in strong volume growth, thereby improving both its top and bottom lines. The bottom line, FedEx had a strong finish to the year with a beat on both the top and bottom. However, as has been the trend recently, guidance fell once again well short of analysts' expectations. While the company hit its FY25 drive target, the tariff-driven headwinds continue to negatively impact the economy. The company's international segment saw its average daily volumes plunge as a result of tariffs, as well as the removal of the de minimis exemption. At the same time, the modernization of its fleet means that the company continues to rack up impairment charges. On a valuation basis, there is more downside from current levels. However, the downside is not big enough to warrant a short position. As such, while I'm maintaining my sell position on the rating with a price target of 202, more for existing investors to exit their positions rather than for new investors to initiate a short. While FedEx management was not as overconfident in the commentary compared to the previous quarter, they're very good at this. The fact that they found merely matching their target as a cause for celebration should worry investors. The macro environment is already giving the company's investors a headache. The last thing they want is for management to add to it with their over optimism, which has been the trend recently. Sadly, FedEx management simply continues to ignore this reality. And with that, that's all the time I have for you this week. Good to be back with normalcy. Good to be back with taking you through all three segments once again. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttamvinay, UTHAMVINAY, or email me on the Stock Doctor Podcast at gmail.com. Thank you once again for listening. And for all my Indian listeners, wish you a very, very happy Independence Day in advance. I hope you really have a great time with your families on the 15th of August. And I apologize in advance if there is some technical issues with today's episode. I will try to rectify them before I upload clearly. But if not, I'd rather get the episode going rather than having to scrap it. So I think there's been a multiple technical issues. So I really do apologize. By next week, hopefully things would be back on track. But anyway, the full episode is back on. So I will see you next week. Until then, stay safe and make some money.